This is Mark Sobel, U.S. Chair, OMFIF. Today, I'm honored to be joined by former colleagues Vince Reinhart and Seth Carpenter to discuss the outcome of yesterday's FOMC meeting. Vince is Chief Economist and Macro Strategist of Mellon. Before that, he was Chief Economist at Morgan Stanley and a resident scholar at the American Enterprise Institute. And before that, he had a very distinguished, illustrious career in public sector, working at the Federal Reserve for over two decades, including as director of the Division of Monetary Affairs. Seth is Chief U.S. Economist at UBS. Seth also had a long and distinguished career in public service. He was acting Assistant Secretary for Financial Markets at the U.S. Treasury, and before that, Deputy Assistant Secretary for Macroeconomic Analysis. Prior to Treasury, Seth worked for 15 years at the Board of Governors of the Federal Reserve, including as Deputy Director of the Monetary Affairs Division. So Vince and Seth have seen their paths cross. I'm going to engage them in a few questions. Perhaps it'll take up to 30 minutes, and then we'll open it up to the audience, and the audience can submit questions in the Q&A function. So let's get going. Let me start with Vince and Seth. In that order. So yesterday, the FOMC issued its press statement, its summary of economic projections, and Jay Powell held his post-FOMC press conference. Most expected the Fed to stand pat, emphasizing the slack in the economy, the need for a strongly inclusive labor market, and overall accommodative financial conditions. At the same time, the last summary of economic projections was in December. I think it was before the $900 billion fiscal package was passed, and certainly before the $1.9 trillion Biden package was passed. So did anything stand out or surprise you from yesterday's events? Let me start with Vince.
So the biggest surprise was that anybody would be surprised going into the meeting. Jay Powell's trying to control his biggest risk, and that is that market participants come to expect that the Federal Reserve is going to tighten too soon. And so he controlled that risk in any which way he could, not thinking about raising rates, not thinking about touching the asset purchase program. It was harder though for what you point out, Mark. Between the December forecast and the forecast released yesterday, there was $2.8 trillion worth of fiscal stimulus and a more assured path toward herd immunity given the progress in the vaccination rollout. So he had to be upbeat about the economy, but reassuring about policy. And the way he did it was there's still risks, and they're willing to tolerate an overshoot, and that they want to run the labor market hot, and they intend to do that.
Well, great. Seth, and maybe you can add, did he thread the needle?
Yeah, so I think he did. I agree with everything that Vincent said. I will add one extra point that surprised me a little bit. The committee in their forecasts for the economy included a forecast for inflation for this year that was 2.4% on headline PCE, 2.2% on core, higher than I would have thought they would have written down as their own forecast. But again, I see this as more of a communications device, and to Vincent's point, as a way to try to keep markets from getting ahead of themselves in terms of Fed tightening. I think what they were trying to say was basically inflation data can do essentially anything they want this year, and we're not going to pay attention to it. So I think there was a very firm statement that yes, the economy is going to accelerate when vaccine rollout continues, when the risk from COVID is back, when some of this fiscal money hits the economy. That might lead to inflation in the near term, but we're not worried about that, whatever. So the word transitory is going to get used, more often this year than I think in any other year.
Well, great.
Seth makes an interesting point there about the summary of economic projections. Jay Powell distances himself from that quarterly survey as far away as he can. But something tells me he was in the virtual building when they put it together this time, because it had two features that were helpful as a communication device. One is there's a pop in inflation, as Seth noted, in 2021, but it's only a pop. And it matched very well with Powell's continued reassurance that we understand inflation will go up, but it will be transitory because inflation expectations are well anchored. And then second, even though the outlook is so much better, there were not that many dots shifting up at the far end, consistent with the message Jay Powell wanted to send. They're going to keep rates low a long time.
Great. Well, we will explore some of those themes as we move on. Well, the growth outlook in the dot plot was substantially higher, and you alluded to vaccine rollout and the macro stimulus. I've seen most forecasts are now somewhere in the 6 to 8% range for U.S. growth this year. On inflation, I think there's a bit of a consensus aligned with what the FOMC did yesterday. That is, transitory bounce up above 2 in the near term, but back towards 2 thereafter. Do you guys agree with those forecasts, or do you have a different view? Let me start with Seth.
Yeah, so we have a little bit of a different view when it comes to the growth for this year. I think the range you cited is correct, and we're sort of closer to the top end of that range, 7.9 for the year on a Q4 over Q4 basis. Part of that difference, though, comes, everyone who's forecasting the U.S. economy this year has some point in time an inflection higher in growth. I think most forecasters are cueing that timing off of when we've reached some measure of herd immunity, so 75, 85% of the population being vaccinated. Boy, I suspect that it's more going to be teed off of when people perceive the risk to themselves as having diminished a lot. We saw a really punchy February jobs report, saw a lot in the hospitality and leisure sector going up. And so we think the acceleration happens earlier in Q2. And then possibly a little bit counterintuitively, we're actually below where the Fed is looking for inflation and where I think consensus is looking for inflation. And that's predicated on a few things. One, if the normal patterns continue, a key part of the inflation indexes is from shelter inflation. Rents bottomed out around November, December last year. The way the BLS calculates these things, it usually takes about 18 months for those inflationary impulses to work themselves through. And so I think that's going to be holding inflation down this year. Second, the big swing in consumer spending towards goods last year and into the beginning of this year, I feel like that's almost surely going to start to swing back towards services in the other direction. And so that means that the third of the core index, that is goods inflation, probably reverts to something closer to its negative average inflation. And so then it's just going to come down to how can the services sector ramp up, and with 9 or 10 million people who were formerly employed in the services sector not currently employed. My view is that there's probably going to be a lot more elasticity of supply than most people are counting on. And so as a result, apart from things like airline tickets, where sure, I think airlines are really good at will be very good at making sure that every flight is booked solid. Outside of that, for lots of other services, I think there's going to be a lot more elasticity of supply. And so we won't get that much of a surge in prices when demand picks up.
Vince.
So we're at the lower end of that range. And it's for two reasons. We know that Larry Summers didn't like the latest round of stimulus legislation, and it wasn't targeted, timely, or temporary. It has a long spend out rate, and we have the evidence that households did not save a significant portion of the March stimulus. There's something like $1.75 trillion of excess saving already accumulated. That suggests a low multiplier. If households remain leery about returning fully to market activity, then it'll take a while to get that spend out. The second part of it is, do worry that there be more scarring associated with the closing of businesses. Yes, business startups are up. You don't undercount a market economy's dynamism, which is why I assume Seth's got an elastic supply curve. But if you leave the labor force don't often come back. If you shut your business, it takes a while to get the credit rating to restart something. And those sort of lingering headwinds, along with the structural differences. We're not going to go back to the office the way we used to, and that will say something about the coffee shop and sandwich shop. So we have at the low end of the range for activity and the higher end of the range on inflation, not this year, about where the Fed is, but next year. And that's an extended conversation we should have.
And great. Well, let's have that extended conversation. So I wanted to begin to drill down on whether you see the Fed's stance as credible over 2021 and beyond. So longer term bond yields were up to 1.7% this morning. The yield curve steeper. You've mentioned the Summers Blanchard argument that the stimulus exceeds the output gap and could stimulate demand pull inflation. Some of the Fed regional presidents had already begun to talk about taper, perhaps even this year. Many in the market expect an earlier liftoff than the Fed, and yet you've already characterized that Powell was very dovish yesterday. So is there a tussle between the market's outlook and the Fed's? When do you expect taper and liftoff? And is there a point when the Fed could get antsy about the rise in yields, and what point do you think that would happen? So probably too many questions, but let me start with Vince.
So from a monetary policy maker's perspective, the hardest thing is to do nothing, i.e. to sit. If you think you have the appropriate policy path in place and your outlook is mostly eventuating, then you're supposed to follow along. But market participants get overeager. They want to see action, and it's tough to convey that you think you're in the right place and are going to keep on course. That's Jay Powell's problem right now. There's two parts to it. The one is he thinks that the U.S. economy has a longer room to run than, say, I do. And that's because he believes that the Phillips curve, if not dead, is pretty lifeless and relatively flat, that inflation expectations are extremely well anchored at 2%, and that he's got some room to experiment with how hot the labor market can run, and give Janet Yellen and Jay Powell credit. They tried that experiment and it worked. And so he's going to try it again. He will have to communicate his willingness to let that happen without longer run inflation expectations rising. He thinks they're well anchored. I think they can be changeable. That's a risk they're taking. For now, what we'll see in yields is the Fed putting their foot on the front end of the yield curve out to 2 years because nobody expects any action, and the tilting up at longer maturities. It's not going to be a problem until financial conditions tighten materially. They haven't yet. Part of the reason is equity markets kind of like that message: strong economy and low rates, the concern about inflation offsets any effect on rates on the exchange rate. So you don't get financial conditions tightening from the other side. They have room to run.
Yeah, and I guess I would say the way you phrase the question, is their policy credible? I think what makes it credible, and where I think a lot of what Vince is describing, we're going to see increasing amounts of tension between Fed rhetoric and markets, is they had the dot plot to try to convince people that they're on hold right now, to try to convince everyone they're going to let things run hot. But always Powell came back to this outcome-based guidance, the fact that everything is going to be data dependent, that if the economy turns out to be different than they're currently expecting, they'll act differently. And so I think as long as they sort of maintain that view, then I think it's believable, because it doesn't pin them down to any specific action. Do I believe that, the dot plot as written is necessarily believable? all by itself? No, you'd have to have the economy turn out the way the forecast works, especially when it comes to unemployment. I think for this year and where the biggest fractures are going to come up, and Mark, you mentioned some of the Reserve Bank presidents talking about tapering and perhaps as soon as this year, I think that's where the next round of real tension is going to come up. And there was actually a small adjustment that was kind of subtle, but an adjustment in the way Powell was talking about tapering, where he said they'll start talking about the timing for the tapering when they believe they're on track to achieve their substantial further progress, and then when they've made substantial further progress, they'll start the tapering. And I think that conversation is going to get increasingly difficult over the next couple of months. If we're right, then the 500,000 roughly private payrolls that we saw for February is only going to build from here, and you could get as many as 1 million in April and May. And they'll have those data prints in hand at the June meeting. They'll also have in hand at the June meeting, that the vast majority of American adults have been vaccinated at the June meeting. And so I think there's going to be just so much of a shift in evidence over the next several months that the effort that Jay had to put into corralling the committee to get the outcome that he wanted, it's going to be somewhat untenable. And I think the first thing that gives is discussion and timing on the taper.
Well, let me just follow up then there. What are your expectations about tapering? Do you have that in your projections or expectations sooner or later? And just 10 years at 1.7, does the Fed care if it goes to 2.1, 2.25? I mean, is there a point that that they get antsy?
Yeah, I mean, so I do think I do have tapering in my forecast. I actually think they're going to get to the point where they sort of are happy with the progress this year. Part of that relies on our stronger than consensus forecast for the economy. When it comes to rates, and I think Vincent was completely on point here. It's more than just the level of the 10-year. It has to feed through to a broader financial conditions tightening. And to put an even finer point on that, I think where their communication has been a little bit muddied, but among economists, I think what they meant to say was you can have interest rates going up now for two reasons: just a pure endogenous reaction that the economy is getting stronger. Interest rates fall when the economy goes into recession. Interest rates rise when the economy is getting stronger. And so if market rates are going up because everyone sees a stronger economy, almost by definition, that can't be bad for the economy as a whole. What they would worry about is an exogenous rise in interest rates that would threaten the economic recovery. And the way you would see that in market prices is that it would be primarily driven by real yields instead of break evens. And second, you'd have to see some concomitant widening in credit spreads. You'd probably need to see risk assets really get hurt, because if the move up in rates is so big that it would impede the real side of the economy, it would start to be reflected in all sorts of risk assets. So that's what I think they mean to say when they talk about not being worried about the rise in rates. And I think we're probably a pretty far way away from that point happening.
Vince, do you agree with that?
Yeah, sure. Again, the biggest risk Jay Powell faces is that market participants get ahead of themselves. There's an outbreak of inflation jitters, and rates rise for the wrong reason. Real rates rise because of concerns that the Fed will significantly pull forward their policy tightening. Powell doesn't intend to do that. And otherwise, they can look at the rise in the 10-year Treasury now and say, okay, it's inflation compensation, somewhat overshooting their goal and then settling in at 2%, their longer term goal. Mission accomplished. It hadn't been an increase in real yields until just the last couple weeks. And by the way, if a higher real yields do anything to cool activity, it's housing, which is red hot. Meanwhile, they're getting the $2.8 trillion of stimulus that they probably counted on, but they have it in their forecast now rather than just an expectation. I think Jay Powell is going to have a hard time keeping his committee together. Seth's right about that. And part of the reason is an important piece of math that bank presidents will be doing, and that is the countdown to a new chair. Fed chairs only have one vote at the table, but they have a lot of soft power. Part of it is the fact that they represent the FOMC and the Federal Reserve everywhere. But part of it is they have influence on the budgets. They talk to the boards of directors of the Federal Reserve bank presidents, and they can lean on them if necessary. However, that's got a temporal dimension. And if you think there's going to be a new Fed chair in 4 meetings from now, you may not quite be as willing to get leaned on. And so that'll be a backroom story to Fed policy making, because let's face it, 6 months from now, everybody's going to be obsessed about who's the next Federal Reserve chair.
Great. Well, this guy that you guys may know named Nathan Sheets once thought that perhaps the timing of tapering may have a bit to do with the transition at the Fed, but that was a very cynical comment, I'm sure.
I don't believe that. I just don't think it. And I'm, by the way, later than Seth, and that's just because the outlook is less robust. And that the Fed is going to be a little slow on the uptake, and running this experiment that leads to higher inflation.
So, okay, well,
although I wonder, Vincent, I mean, you push back hard on the timing of tapering with respect to the transition. I think in current circumstances, that's probably right, just because I don't see what Powell would stand to gain by gaming it necessarily. But part of me does wonder, the last time when they started to run off the balance sheet, if it wasn't sort of set on what they thought, in my view wrongly, but they thought at the time as a very, very slow runoff right before, the election, right before a potential turnover in the Fed chair. Do you think this time is different, or do you think sort of chairs don't take that kind of temporal component into their thinking?
So in my household, we reserve the term "this time is different" for other contexts. I would think Nathan's working backwards from to be the chair that implements a taper before the turn of the year is to be a chair that is not as dovish as the current administration would like, and therefore cements turnover, and that being as seen as dovish as possible furthers the chance that he could get reappointed. I don't think they work that way generally, but in particular, I don't think that Jay Powell has to give the false appearance of being dovish. He is dovish, and the right thing for him is to put off the actual taper as much as you can. He was there in the building like you were, and live through the taper tantrum. It's gonna be, it is gonna have a very, very long runway before they actually do it. So yeah, will they be talking about tapering at the end of the year? Probably. Will they be in the position to actually slow asset purchases? Don't think so.
Well, good. Let's move on to an issue I think both of you have alluded to. And I say this to two guys who probably have drafted a few FOMC statements in their lifetimes. So you've alluded to kind of an unenviable communications challenge. You're going to have booming growth later this year. You've got heavy accommodation. The markets may have a faster expectations for Fed liftoff and taper than Powell has communicated. There's going to be differing views within the FOMC, and you saw a little bit of that in the dot plot yesterday. So, and the Fed can say what it wants, but it also needs to be credible to markets. There needs to be kind of a symbiosis between the two. How does Powell master that potential scenario when he wants to be very dovish from a communications standpoint? Like, what would you, Seth, if you had the pen, how would you deal with this conundrum?
Yeah, I mean, I think what Jay is going to have to end up leaning on, and he's already laid some of the groundwork for this, but the conditions that they've laid out, for example, for hiking short-term interest rates are twofold. One is having realized PC inflation at 2% and not on a transitory basis and likely to go through 2%. That seems reasonably clear, reasonably crisp if we ignore a bit how much discretion they'll have this year to label higher inflation as transitory. But the other condition, and it's an and condition, not an or condition, is that the economy is at full employment, and full employment is very much in the eye of the beholder at this point. And so Jay has talked about specifically the unemployment rate itself is far from a sufficient condition. When asked, I think at a recent interview, if 4% unemployment and lower would be where he wants things to go, he said that would be great, but just remember, full employment is about much more than the headline unemployment rate. And so I think what that means is he's got a large amount of discretion, and that he will end up having to use internally within the committee, as well as in terms of external communication with markets, to try to maintain that dovish stance. So I think that's the direction where more and more is going to where more and more effort will be placed in defining as many possible variables that they can lean on in labor markets to assert that they're not yet at full employment.
So it is the case that on my tombstone it'll read, "Here lies Vincent Reinhart for a considerable period," and that was because that was an attempt to draft an FOMC statement that would damp down on the expectation of too soon a policy firming. They're going to have to work hard to do the same. I suspect what Jay Powell is going to do is try to address more the readership of USA Today than the Wall Street Journal. Just keep repeating a simple message that I am not concerned that the labor market gets too hot. I am not concerned that measures of the unemployment rate are falling. What's so bad about that? We have anchored inflation expectations at 2%, and these people pricing securities are just ahead of themselves. If he can do that convincingly, it sort of blunts the transmission of long rates into equity prices and to the exchange value of the dollar. It makes it more likely financial conditions don't tighten as materially. And otherwise, he says, higher long-term rates are not a problem because it is the lifting tide of economic progress that is raising that boat.
Okay. Well, one other question. I mean, we see, this is more of a longer term question, but we see Treasury deficits very high, lots of paper on the market. I assume that the US may want to avoid too abrupt of a fiscal cliff when we get to the other side of the pandemic, and there may be perhaps a prolonged fiscal taper, which again implies more paper on the market. Which could push yields up or prop them up. Do you worry about that putting the Fed in a position where it has to keep buying and buying down the road, fiscal dominance, implicit yield curve control of any kind? Start with Vince.
Well, I would suggest that the operator of your website has that concern, because the banner for the discussion of FOMC policy was a view of Capitol Hill. And actually it was Pennsylvania into Capitol Hill, i.e. the road to monetary policy actually is directed toward politicians. I think that's a risk. I think that when you look at the long run of history across a lot of advanced economies, you don't linger all that long at where deficits are as high as they, debt rather is as high as it is relative to GDP right now. But we don't have the mechanics in place to work it down the way they did in these previous episodes. Episodes coming out of a war, it was easier to run surpluses. You were remobilizing labor force. There were lots of technological advances, and you usually got a burst of inflation. And even then, what tended to happen was real interest rates stayed unusually low, quite negative, financial repression. We're not going to work down. We don't have those mechanisms in place now to make a lot of progress in lowering debt to GDP other than financial repression. And I think there'll be a lot of pressure on the Fed in terms of fiscal dominance, in which a little bit extra inflation is just not going to seem so problematic for monetary policy officials over the medium and longer term.
Interesting. So I think everything Vince says makes sense. I guess I would bring up a different risk that could potentially lead to the same outcome, but could lead to all sorts of other problems for Fed independence and Fed governance. And it's the following. I don't think in the near term, which may have been, Mark, how you were laying things out, that the increase in supply is going to push up rates, at least not for the next year or two. There's actually a huge amount of cash being generated by current coupon auction sizes. The Treasury is running down at least $1 trillion from its cash position at the Fed. So that's essentially debt that was already issued last year that the Treasury is accessing, and bills in the market are super rich, and so the Treasury is going to lean in that direction. So I don't think coupon auction sizes actually go up at all for the next couple of years, even if there is additional fiscal policy later this year. So the near term, sort of the market having to digest a bunch of duration risk, I think is actually less than the market is currently perceiving, and that's going to help keep rates in check. Where I do worry is a repeat of the types of episodes that we saw in March of last year, September the year before, even though they were very different in nature and different in drivers, just the sheer volume of paper that's going through markets that has to be intermediated. I don't think the pipes of the system are as well equipped to handle it as possible. And you could easily have additional bouts of disruption, additional bouts of the dealer side of things pulling back because they need to be very cagey with their balance sheet. We saw this just a couple of weeks ago with the 7-year note auction, where dealers ended up holding $25 billion more paper than they probably had intended to. And it ends up with severe price moves. And so I think there we have a market functioning risk that gets bigger and bigger and bigger, just the larger the overall quantity of Treasury supply there is. And that could cause the Fed to have to come swooping back in to save the market one more time. And I think at some point, Congress just gets sick of that, of the Fed throwing in trillions of dollars in resources to fix markets that are not currently super popular among politicians on Capitol Hill.
We'll actually have a case study this by Friday with regard to what the Federal Reserve and the other bank regulators do with the supplementary leverage ratio, whether they grant an exemption, extend an exemption. If you're risk averse about market making, you might, but there are taking a lot of heat for that. And Mark, to your question about would there be inroads to central bank independence, I think it's instructive to ask yourself, when did central bank independence gain such steam? And it was in the late 80s, 90s, when society was fighting the previous problem, high inflation, and politicians were willing to grant some autonomy because debt was pretty small relative to GDP. Well, if you reverse those two things, the previous problem actually was concern about activity and low inflation, and you're coping with large levels of debt and debt projections that just look really scary over the medium and longer term. Might you actually erode central bank independence? I think the answer is the road is to Capitol Hill.
Thank you for that. I definitely think that the discussion around central bank independence could get quite interesting over the next decade, unfortunately. But we will see. A few questions are coming in from the audience, including from David Marsh, who is Mr. OMFIF. So I better ask his question, but it dovetails with a piece I wrote earlier this week, where I postulated that with the US going big and Europe more restrained and China probably showing some restraint to curb leverage, you're going to see divergence. And this could cause a substantial widening potentially in the current account deficit. That would act as a safety valve for inflationary pressures in the US. But at the same time, and this was less of a problem you guys had to deal with, but that I had to deal with is, fights about global imbalances and currency wars and whatnot. So there are questions about this divergence and its international implications or ramifications and how you think about it. I've already said how I thought about it, but how do you guys think about it? So who wants to take a stab at that one first? Seth, I'll pick you.
Yeah, sure. I mean, I think divergence is a very likely outcome. Like I said, I'm on the optimistic side when it comes to US growth. I think with it, we see more of that same endogenous increase in rates. And so especially for this year, there's probably some increased tension in terms of interest rate differentials and capital flows between US and Europe. I think the interesting challenge here, it would have been interesting to watch that play out with the previous administration and its stance towards Europe. I think it's going to be that much more complicated for the current administration, where they're trying so hard to have a rapprochement with European and traditional allies. And as the sort of economic strains get bigger and bigger, it will be interesting to see how that the political dynamic works out. But no, I think it seemed pretty clear that there will be some adjustment and tensions. I think U.S. policymakers, though, have moved in the direction of caring much less about where the dollar is going specifically, unless there are just very, very rapid, aggressive moves that don't look like they're going to stop. Some fluctuation, I think, will be the willingness to permit fluctuations in the value of the dollar. I suspect are higher now than they would have been 10, 15, 20 years ago.
So I think we are in store for divergence big time. That Jay Powell is right that we will not be on the road to full recovery until people are willing to engage in market activity, and that there is another wave of infections in the euro area, and that we're seeing a lot of trouble in vaccine rollout and a willingness to lock down economies. There's gonna be a fair-sized gap between U.S. growth, certainly in the next couple quarters, and how the euro area is performing. You see it in the way their leadership talks about the backup in yields. As we were saying, Jay Powell was pretty nonchalant about the 10-year Treasury yield going up. There have been numerous ECB officials over the past a week and a half since the Governing Council meeting expressing concern about that and the need to do something. And then in between is the Bank of England that issued a press, the Monetary Policy Committee today issued a press release that kind of looks like Federal Reserve policy formulation. Wait to see inflation go up. And be willing to keep stimulus in place for a while. They're not quite as willing to toss out the outlook as Jay Powell is, but UK seems to be in between. And oh, by the way, in terms of the exchange rate, if our forecast is right, yes, the divergence means you're going to get this widening wedge between real interest rates here in Europe, and that will put upward pressure on the dollar, all else equal. Our medium-term worry is everybody's going to be concerned about inflation and Treasury debt outstanding, and that'll be a headwind that offsets the force of rate divergence.
Well, good. A lot of people in the FX market are issuing bearish pronouncements. I had written a piece at the beginning of the year saying I thought that was wrong, but we'll see what happens. But that ties into maybe another question that some in the audience have loosely referenced, and I had on my mind as I listened to you. And it's this concept of financial conditions that both of you have referenced, because they're talking quite a bit about it in Europe today now. That's the way Philip Lane is framing a lot of his arguments about the future of ECB policy. I don't really recall financial conditions being a major term of art in US discord. I mean, clearly it was there. You have all these financial conditions indexes, which have, numbers about the dollar this and bond yields this and what the proper relationship is, et cetera, et cetera. I mean, can you help me understand more concretely if there's a easy, smart way, more precise way to think about financial conditions? And
so I would say President Lagarde pitched a pretty big tent describing financial conditions at the press conference, where she included business lending and attitudes, and as well as all sorts of market phenomena. Financial conditions are something like labor market conditions that are easy to assert but hard to measure. Historically, the Federal Reserve had been suspicious of using financial conditions as a key describer of policy, because you could get the same movement in financial conditions with different real shocks. The exchange rate goes up, but interest rates go down, or the stock market goes up, and you could all add up to the same gross change in one index that could have quite different consequences for the economy and where you should be setting policy. And that you're much better off thinking about the forecast and your outlook in that finer grain detail. I think talking about it now, and they do, is just an easier way than explaining what I just did. That, we think about our outlook in all these different terms, and it's all these variables we look at, and it all matters, and it depends on why they're moving. It's just easier to pitch a tent and call it financial conditions and say, we look inside that tent, but don't try to add it up to a single number.
Yeah, I think I agree, because Mark, the way you phrase it, is there a both simple and smart way of looking at financial conditions? And I think, likely agreeing with Vincent here, the answer to that is no. And usually the way these things get done is you take some model of the economy or some historical empirical relationship between a relatively small set of variables, and then use those as weights to construct the index. I think so that makes it simple, but I don't think it makes it smart, because so many of these relationships change over time along the lines of what Vincent alluded to. And so where I think policymakers are likely to go, at least at the Fed, is to say, let's look at let's round up the usual suspects: credit spreads, equity prices, level of interest rates, both short and long, and then ask ourselves, do we think that there is some, again, exogenous move there that we need to change our forecast for the real side of the economy in order to capture what's going on there? So very judgmental, very difficult. You can have simple or you can have smart.
Okay, qualitative, not quantitative. Just as a quick add-on to that, one of the viewers commented that I had raised the issue about, could the Fed be antsy about bond yields? So what about antsiness over the equity market level, investment behavior, et cetera? How does that filter into the reaction function? This fits into the financial conditions as well. Any comments on that? Fed and equity markets?
So I think if you were a reporter who asked this question at a J-PAL press conference, he'd kind of look a little irritated at you. Of course, we look at everything. Of course, things matter, but we have a general responsibility toward financial stability, but we take, perhaps using President Lagarde's term, a holistic approach to thinking about rates and yields and prices. And so it doesn't matter to us until it matters to the forecast. And by the way, one thing he did enforce pretty strongly yesterday in response to a couple of questions is he's a firm believer in the separation theory, which is if you're a central bank and supervision is done right, then you're free to do whatever you want on monetary policy. Don't try to adjust monetary policy for something that is better suited to be dealt with supervisory. And he said that a couple different ways. I think equity prices is one of those.
I completely agree with what Vincent just said. And I'll make an additional observation that, when I talk to clients globally, I think there is one of the places where there's a mismatch between how markets think and how folks inside the Fed actually think. Markets believe that there is much more weight in the Fed's reaction function on the S&P 500 than there actually is. I think the Fed is much more willing to tolerate moves in the S&P than the market realizes. If you had a 2% decline in the S&P over the course of 2 days, markets would be running around with their hair on fire, and the Fed would. Some people within the Fed would have noticed it. And then when they're writing the memo to the policymakers about this move, they would point out that it's well within the standard errors of a typical, 2-week movement. So I think there is a pretty strong misunderstanding of how sensitive the Fed is to equity prices per se.
Well, you guys are getting me into a train of something I've written about, and it's one of my favorite hobby horses. It's financial stability concerns. So reach for yield, lower for longer, creates potentially financial stability risks. The Fed regulates the banks. It doesn't regulate the non-banks, which are more of an FSOC, SEC issue. But if we have financial stability problems, they certainly impact the dual mandate of the Fed and its execution of that. You mentioned the separation. I think it's fine to have separation if you have decent macroprudential policies that you can fall back on. I personally think the U.S. Gets very low marks on macroprudential policies. And I think the structure of our regulatory system is such a mess that it prevents us from moving in a much better direction. How do you see financial stability risks? Do you worry about those impacting the dual mandate? Do you think we're doing a good job in the America on that front? And what more could the Fed do, given that it's responsible for banks and it handles those relatively well? What more could the Fed do about risks that are outside its domain, but that would hit its turf? Seth, we'll start with you.
Sure. I think there are two parts, though, at least implicit in the way that you asked the question. One, are there risks? But then the connection or potential separation of financial stability policy from monetary policy forces the question of what tools. You mentioned macroprudential tools, but I think there's also the question, is there do standard monetary policy tools actually address the sort of financial stability risks that are most likely out there? So I think there's a fairly clear view among people that lower, if the Fed were to keep interest rates low for a long time, it should boost equity prices. And if they were to raise short-term interest rates pretty aggressively, that would probably bring equity prices down. I'm not quite sure that that framing of it, though, gets at what the real financial stability risks are. I mean, I do think leverage is a huge part of it. The three of us are old enough to remember when the Fed funds rate being at 2% would have been considered extremely low and very, very accommodative for 2.5%. And now the Fed sees 2.5% as its sort of long run neutral rate. And going from here to 2.5% would presumably represent a pretty dramatic tightening of financial conditions, whereas historically you would have thought 2.5% was too easy and maybe creating bubbles. So I think there's a very, very difficult incomplete framework in anyone's mind about, in the collective sort of central banking mind, about what the relationship is between short-term interest rates and financial stability. And then to think about the risks. I am worried about risks, but a lot of them are along the lines of what I was talking about before, sort of market functioning risks. How much leverage do we have in the system, both public and private? And what does that mean? And so far, what it's meant is when something goes wrong, in comes the Fed, possibly with the Treasury at its side, to bail out a bunch of people who took some risky positions, as opposed to, gosh, we have a bunch of pipes, we have a bunch of machinery for financial markets, and we haven't redesigned them, recalibrated them to the sheer volume of leverage in the economy. The corporate bond facility that the Fed and Treasury put up together, makes sense. You want to make sure there's money flowing to Main Street. You want to make sure there's money flowing to businesses that are the real side of the economy. Well, that's all well and good, but never is there the conversation with the SEC or others. Should large corporations that are systemically important to the real side of the economy have limits on the amount of leverage that they take, or is it okay for them to be super levered? And then when there's an adverse shock and credit market seize up, we need official sector intervention to bail people out. So I do worry about financial stability risks. I'm less convinced that monetary policy tools are particularly effective at fixing them.
Yeah, I would say that monetary policy tools are not well suited to fixing them. And they're really, but one aspect you have to recognize is, as Seth said, nominal interest rates have trended, and real interest rates have trended lower and lower. Most asset pricing conditions are of the form, there's a stream of interest of future income at the top, and it's divided by a discount rate or an interest rate. If that interest rate is very low, like it is now, even small fluctuations in the interest rate get you big price changes. And so I think we're going to have to accept, if the Fed is right and 2.5 is a cap on nominal rates, then that thing in the denominator is going to be low and potentially a source of volatility. Fed's monetary policy isn't particularly well suited to addressing one market, and the idea of moving away from your achievement of the dual mandate for financial stability risk is going to be a tough sell at the Federal Reserve. But we should also remember the Federal Reserve has a lot of reach into the financial system, and not just because it's a bank regulator and a member of the FSOC. It's also operates the payment system. It operates Treasury securities, government securities only exist because they exist on the Fed's books. And so it does have influence outside of banking, particularly some of the junctions in the pipes that Seth are talking about, central clearing parties and the like. And the Fed can be a source of good for that. Consider the example of CLS, which did a lot to clean up settlement risk for foreign exchange markets. Wouldn't be there but for the Federal Reserve.
Okay, well, we're only a few minutes left. Let me just try a few questions. First of all, one of the viewers asked, in light of our discussion about the external sector, if the Fed cares about trade deficits. I remember Greenspan had this line about we care about the external sector to the extent that it impacts the optimal functioning of our domestic economy. Could one of you, maybe Vince, you worked in international, Seth, I don't think you did. So Vince is going to get this one. What's your 1 minute take on the Fed and how its philosophical worldview on the international sector and how important that is? And maybe I just throw in on that. I think that given the Fed used to have a heavy real focus, but with financial markets providing a much stronger channel, that the international dimension weighs on them more than it did in the past. But
so it should. Listening to Powell's press conference yesterday, it sure sounded like the U.S. economy stopped at the water's edge. But I think it's a couple things. One is the US is not as dominant in terms of its overall footprint in the global economy. It relies more on trade, and it relies importantly on financial services, all of which have a strong international dimension. And there are more entangling relationships in bilateral and multilateral trade agreements that got to be. And by the way, emerging market economies importantly are influenced by the availability of credit and commodity prices. So it's a complicated world, and the Fed has to take that into account. The answer is it does, but just in the same way that they'd be very suspicious to describe fully what labor market conditions are or what financial conditions are. They're going to be extremely suspicious and hesitant to say, here's the part about the international economy we care about. The answer is we should care about it, all of it. And they have to care more about it just because the US is a smaller part.
So thank you for that. So, well, there are far more many questions than there is time. A question on building out on SLR exemption. Is it right that eliminating the exemption will cause banks to reduce treasury holdings, causing treasury yields to be higher? And does the exemption benefit the banks or the treasury more? And given Powell's fear of taper tantrums, unruly markets, wouldn't the Fed see eliminating the exemption in the current volatile environment as particularly risky? Seth?
Yeah, so let me take a stab at that. So I think the Fed sees eliminating the exemption as risky. I think plan A is to try to get the exemptions extended if you can do so without truly provoking the ire of the political class, including Congress. I think plan B is to try to do as much of that as you can and still allow people to have a modest amount or moderate amount of ire. So I think that's where the Fed ends up doing. We got to remember there are two leverage ratios here, one at the bank holding company level and one at the depository institution subsidiary level. The Fed has essentially sole discretion over the bank holding company version, and then they have to rope in the OCC and the FDIC for the DI level version. So, what happens if these exemptions aren't extended? I think the reserves portion of it does get extended at both levels. I think the OCC and the FDIC swim up to the idea of the reserves. I mean, that is clearly the single most liquid, safe asset you could ever imagine. It's just money, central bank money. And I think there's an understanding in policy circles in Washington that the only reason why the leverage ratio is getting constrained by reserves is the Fed's own policy actions that they're doing for very specific reasons. So that one should be a little bit easier to get across the finish line at both levels. I think when it comes to the depository institution level exemption for treasuries in particular, this is one where FDIC Chair McWilliams has said, maybe that should only be done at the holding company level. I don't think it causes banks to just disgorge a bunch of the treasuries that they're holding, but it probably reduces the bid. And so on net, there's modest upward pressure on yields there. But I don't think it ends up. So I think there's a combination of benefit for both banks and the treasury. Not as big for the treasury as one might otherwise think. The banks tend to hold more shorter dated paper on average, and as Vince was saying at the very beginning, out to 2 or 3 years, those rates are pretty well pinned by expectations for monetary policy. So it's difficult. It's a politically fraught issue. I think the Fed very much wants to get the exemptions extended so that they don't have to worry about the impact of their own asset purchases, and the reserves really are much larger on banks' balance sheets, and getting larger. We'll be past $5 trillion in reserves before long, and that's where the real binding constraint is. And I think it should be easier to do.
Great.
Yeah, it's more about later in the year, and as the Fed continues its asset purchases and the Treasury runs down its cash balance, that you really see a big buildup of reserves, and that would be a problem for big banks. I would say the concern isn't so much what happens the day that the Fed announces it. It's did they just move the guardrails out a little bit? And that will markets be able to handle stress as a stressful situation as effectively? And the answer may be no.
Well, great. We've run out of time. You've been spared questions about climate and inequality at the Federal Reserve. I'm sure Vince would have had a reaction to that. But the next time, I thank you for a fantastic presentation, very lucid, greatly benefited from it, and I'm sure the audience did as well. Thank you, Vince Reinhart and Seth Carpenter.